Good afternoon, everyone. Welcome to today's Wednesday market review. My name is Stock Darts, and we were going to do what we always do on Wednesdays today. We're going to go ahead and take a look at the four major market indices. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish looking at the four markets and examining what kind of environment we're in, we're also going to take a quick look at the US dollar. We're going to see how it's affecting oil, gold, silver, as well as how Bitcoin and Ethereum are behaving, as well as maybe some other cryptocurrencies. If anyone in here has a chart request, feel free to type it into the chat. I'll be more than happy to go ahead and take a look at it once we cover the markets and commodities. If you like what you see here, you can always follow me on Twitter under the name Stock Darts, YouTube under the same name, or you could visit me at patreon.com/StockDarts, where I post weekly blog content, including trade ideas, watch list ideas, as well as just generally expanding on whatever we cover during these Wednesday market reviews. Typically what we want to do is try to analyze what kind of a market environment we're in. Whether it's a strong bull market, whether it's a choppy market. Typically in the shorter term, I think it's pretty easy to tell in the long term that we're in a pretty strong bull market, but in the short term, there's a lot of fluctuation that happens back and forth, and so we try to meet up every Wednesday and see if we can figure out what kind of environment we're going to be in from week to week. And if you like that sort of thing, again, the best place to follow me, to look for more content, is patreon.com/StockDarts, where, like I said, typically you'll see what kinds of trades I'm employing as I try to approach the current environment of whatever the market's given us. Other than that, let's go ahead and get started. First thing we're going to do is take a look at the S&P 500 through the ETF SPY. And for those of you that were here last week, you'll know that I mentioned there was a pretty good chance we were going to have a bounce last week that was going to head up into the moving averages as well as this descending trend line, and then we were likely going to be met with more selling pressure than we could handle, and that is exactly what happened. Yesterday we had a pretty big down day as the markets kind of caved in after attempting to really push through what was developing into a key area that we needed to overcome. And as you can see, we sold off pretty hard into the afternoon, and today we are printing a nice little doji, trying to hold up at support, and we'll analyze that in a little bit more detail. But right now the markets in the short term are probing downwards. They're looking for support. They're trying to figure out where buyers are willing to step in and really defend price action. We are not at a spot where we're looking to figure out where the ceiling is. We've found our ceiling for the short term. Now, is this a long-term top? Probably not, but it's too early to tell. It could be that this ends up being a market top that we take months to recover from. But I think it's, like I said, it's a little too early for that. I think we've seen a pretty steady incline on the S&P 500 that needed to be broken, and oftentimes when you first break through a channel like this and you come down and you consolidate, that doesn't signify the end of that particular bull rally or of the bull market. It just means that the market got a little overextended and needed a much larger consolidation phase in order to find new buyers that were willing to step in at these elevated prices compared to where the rally started. And as you can see, if we scroll all the way back and take a look, last November, so we're going on almost a full year that the S&P 500 was rallying in a very orderly channel up, just without really breaking it until recently. And sooner or later, these kinds of trends do need to kind of reverse. And so, is it the end of this particular rally? Maybe of this channel, but not necessarily of this bull market that began. Well, really, our bull market has been going on for a lot of years, but as far as this particular phase, this doesn't necessarily mean it's the end of this phase. We could just go sideways for another month or two, and then maybe begin a new rally as we head into November and December and start a new holiday season off on the right foot. So I hesitate to say that we found a market top or that we found a top for the year. It is possible, but it's a little too early for us to tell, and definitely within the scope of what we do on these Wednesday market reviews, a little early to really figure out. What we want to figure out now is where are we heading next, now that we've kind of failed to reclaim some important areas here on the S&P 500. And that's going to be basically the basis of today's session, is trying to understand where we're going to go next from here to next Wednesday, and possibly maybe the Wednesday beyond that. And we're getting mixed signals, which we'll get into in a minute as we move on to the other indices. But it looks like maybe we're getting some rotation along with this correction. Now, if we're just looking at the S&P 500, like I said, this was a pretty important area. So what we had that channel that we just backtracked and took a look at, right? And we finally had it broken. And more often than not, once that breaks, you have a quick drop, and then you have a bounce to kind of come up and retest and try to prove that breakdown is false, right? And so that's exactly what we had there. If you go ahead and you take a look, we've got a couple trend lines that we can draw here. One is the trend line we already had in place, which is right where we broke, right where you had this convergence. We had the 20-day moving average, we had this descending trend line, we had the channel coming up, and so we broke down right at 447. And we held for a couple days, and then we really accelerated that breakdown once we started to lose 444 or so, right? And so that was the area that we came back and retested, which not coincidentally was also the 50-day moving average. So we've got this little band between about 446 and about 444, so a little $2 zone. And that is now the strong ceiling or resistance area that we will need to break through before we could start looking at maybe pushing to new highs or pushing beyond them. And I suspect that we will not be able to break through this on the next bounce, whether that comes at this level or whether it comes as we head down and test 422. Now that we've established what is more than likely to be a short-term ceiling, and again, take a look, we've got the 20-day moving average, we've got the 50-day moving average, we've got this descending trend line which is starting to really develop, and we've got these two levels that used to be support that have now flipped to resistance. That's a lot of indicators here that can all point to signs of selling pressure and of overhead supply. Now, to the downside, if we start to look for support areas, we broke through pretty quickly this 438 level, which wasn't a substantial level to begin with, but was a previous resistance area that did act as support on one bounce as we came down and tested this channel. We really just kind of sliced right through that, right? And it actually became part of maybe this gap here around 436.80. And in reality, what we ended up doing was we've established a short-term support level, but it's a short-term support level that's kind of in the middle of a kind of a larger zone, right? If you take a look here, we had a nice little band from about 438 to about 423, and I suspect that this level here, 432, doesn't have enough significance to hold for too long, and so likely what's going to happen here is maybe we try to bounce today, tomorrow, and come up and retest this descending trend line and the moving averages. We probably fail again, and we come down, and I think that this is the level that we need to be looking at as far as buying the dip is concerned, or as far as trying to figure out where stronger support is lining up. And I think it's going to be right around 422, 423, right as we hit this, which I think is going to be the level that we could kind of expect more buyers to step in and expect more demand to resurface than what we're seeing right now. I think the market is on its heels right now, and any bounces we're seeing are pretty short and reactionary. And I think even if we do get another bounce now, unless it could get through this band here at 444, 445, we're going to head down and test 423. And so this is the area where we want to be more patient and wait until we get to, if we're looking to buy the dip, if we're looking to start to enter some more long positions. Even if you're looking to scale in, some nice names have been starting to get hit. Names that we tend to look for as far as long-term positions are concerned. And if we come down to this 422, I think that's a good spot to maybe look at a couple. However, I think because of the nature of this last rally we had, where we had an uninterrupted rally for almost a year, and the fact that we're starting to see price eroding, I'm going to go ahead and say that we probably want to be more cautious as we start to approach our trading into October. And we want to wait for more clear signals before we get overly aggressive, even buying these bounces. But I do expect a pretty decent bounce opportunity coming at 423. And my inclination right now is to suspect that what the S&P 500 is going to do is not necessarily continue heading south and break through all these key levels, but start to establish a more sideways range. And I think that this 422, 423 could be a pretty good floor for that, at least in the short term. Now, longer term, again, if we look at where we've done in the weekly chart, there's so much room for us to pull back, and even just to get to 50% of this recent move. And so there's room for us to come all the way down to maybe 400, possibly even a little bit beyond that. And we still have a very intact rally that is still well above the previous long-term range that we spent a long time building out, or the previous base, right? And so if you look at it from this longer term picture, you'll realize that our bull market is not really in danger right now, but our accounts are, if we are over leveraged, or if we don't have the right risk management protocols in place, because we could drop easily from where we are now down to 400, or down to 380, down to 350, and still be technically in a market that's steadily climbing upwards. And that would be a huge drop that would hurt a lot of people's portfolios and a lot of people's bank accounts. But it would still be within the norm of the normal typical ranges that stocks and equities move through as they kind of go up. As you can see, we've had, since the post-COVID kind of bounce that we had when we had the outbreak in the beginning of last year, we've rallied sharply from 228 all the way up to a high of about 453. And we really haven't paused, and we really haven't had a major consolidation or major correction during that time. And so we're bound to see one, whether it's now or whether it's at the beginning of next year, the middle of next year, but we're bound to see one at some point in the near future. And when we see that, we want to make sure that we're prepared for it, and that we're not kind of caught with our pants down, over leveraged, as a market is kind of starting to lose momentum at highs, right? And so, well, I think it's early to really worry about a major correction. I think that we want to start to be a little bit more careful about how we go ahead and approach our bounce plays. And for that, I think the first level is going to be when we come down and test this 423. I think we're going to have a bounce, and I think it's going to be a good bounce, and I think it's going to be a bounce we could profit from. But I think we want to be careful about how we go ahead and structure our plays, and how we go ahead and structure our portfolios, to make sure that we don't continue to get over leveraged, or we don't build too big of a position in a market that is starting to lose momentum. We want to see it regain its momentum before we get overly aggressive. And at this point, like I said, it's a little too early to say we're at a market top, but I also think it's a little too early to say that we are ready to, that we're just going to go ahead and keep rallying and continue climbing upwards. I think we're in one of these kind of more vague or ambiguous market areas where it pays to be careful, and it pays to make sure that we have bullets left in our gun in case that the market doesn't give us what we want. So the last thing we want to do is over leverage just because we finally are looking for a bounce. Maybe you missed a lot of this rally and you feel like, well, I'm finally getting the dip I want. I think that we need to be a little bit more careful as we head into October. October can often be a difficult month for trading, and it looks like it's setting up for that again. And so we want to make sure that we're careful with that. So the key levels on the S&P 500, as I just outlined, is our ceiling is going to be right around 445, maybe a dollar above it, a dollar below it. We have very short-term support of 433 that I doubt will hold. We have a much stronger area of support that should hold, at least on the first pass, around 422. If for whatever reason we do get a much stronger market correction than I'm anticipating, another strong level is way down here at 400, 397 to 400. I don't anticipate that's something that we need to worry about in the short term, but it is a level we want to watch if we continue to kind of lose price action and continue to kind of fall backwards. Yeah, so those are the key levels, and we're actually kind of right in the middle, right? Because we've got about $10 to the upside and probably about 10 or 11 to the downside. So there is potential that we bounce again before we fail, or that we just drop straight down. So not a good week to trade, not a good week to really be overly invested or overly active in the U.S. stock markets. All right, if we look at the NASDAQ, it looks weaker. In this case, you can see, at least in the short term. In the long term, I think we're still pretty strong. You can see, I think the NASDAQ is the nice exhibit as far as what I mentioned right now with the S&P 500, that just because we lose a channel doesn't mean it's the end of that particular market environment. We had a nice strong rally into the holidays, into the start of this year, and then the NASDAQ stalled out and had to build out these wide bases before it began to rally again, right? And so The S&P 500, to a certain extent, is still kind of here, or starting this kind of a phase, only it's starting it at the highs. And there's a chance that it mimics the NASDAQ, or there's a chance that it does something totally different. But this is a good example of why you can't just assume that we've hit a market top because a channel is finally ends. A lot of times that's just the end of that particular market thrust, and you need broader consolidation. You need broader areas of chop in order to get new buyers to step in at areas that they consider to be good value. And so, in a nutshell, the psychology behind that is you get a lot of smart money, or whatever you want to call it, bulls, buyers that buy in right around this level, right? And as it comes up, they start to get antsy because they want to take profits. However, there are some that didn't buy that also want to start taking advantage because they feel like they missed out the move, right? And so the weaker hands, or the more impatient ones, they start to buy as this moves up. And usually those are the ones that get punished, as once enough traders from this area here decide they want to take profits, we start to correct, right? And those that chase long start to sell off as well because they panic. And then some that miss this move finally come right back in, and they finally buy at a good value. And you get this back and forth as you have people taking profits, and you have those that missed the move, or those that took profits that want to go ahead and re-enter at what they consider to be value. And once you have enough shares exchange hands where there's enough profit taken and enough new blood in there, that's when you start to get these bigger rallies, and you start to get the new markup phases. And so just the fact that we lose this channel, you just need to go through this process of going back and forth and getting new buyers into whatever equity it is that we're looking at. And so where we stand now is, again, a pretty decent profit taking area, and a lot of NASDAQ stocks rotated pretty strongly as we started to head into the summer. And we're starting to see some selling pressure here, and it's selling pressure that isn't exactly being mirrored on the Dow and IWM, which we'll get into in a minute, showing that maybe there's more rotation coming out of tech again. And so now the question is going to be, how far does this rotation go, and is tech going to be a good buy as we kind of correct? And I think that's a question that probably is not going to be answered soon. I do think, like always, for those that maybe follow me regularly, we focus a lot on tech stocks here. I still think tech stocks, because of just the type of environment we're in, the type of society we have, tech stocks tend to be the new leaders, and they tend to be some of the easier stocks to go ahead and get back into, because they're some of the safer stocks, quote unquote, as far as however safe you can consider a stock. And so I do like to buy them on dips, and I feel like there's always rotation back into them. However, that being said, in the short term, this is not the kind of pattern that is conducive to a dip buy. We have an extended down move yesterday, and again we have the same pattern that I just mentioned with the S&P 500. We broke down, we came up, we retested exactly where we broke down from, and we failed. And we headed down with volatility increasing. Today's candle is not inspiring confidence. And this looks like where we're going to hang up maybe for another couple days and then continue on downward. Now, just like the S&P 500, I think there's a pretty clear level that would be a very good dip buying opportunity. And I think on the NASDAQ, it's even a better opportunity because it's going to be much closer to the 200-day moving average. However, we may not get all the way down here to 342, but if we do, I consider that to be a good area. Now, one thing I forgot to mention with the S&P 500, I'm going to mention here, is if you're looking to buy dips, if you're looking to buy as we hit these levels, keep in mind, you don't want to just buy as soon as it hits that level. You still want to see the candles or some kind of a pattern that tells you buyers are stepping in, right? That's kind of important because you don't want to just blindly buy a level with price action the way it's behaving, because it could be that it takes weeks before it stabilizes enough to give you a bounce play. It could happen right away, as sometimes happens, but sometimes it takes a while. Take a look at this last time we headed down and hit support. Anyone that tried to buy support the minute it hit that level would have ended up losing a decent amount of money. It only took about a week before, or a week and a half before it started to bounce. But for anyone that didn't wait for this reversal pattern, they could have been stopped out of 2 or 3 trades before it finally bounced and gave them the move that they were looking for. And that kind of pattern happens often, so you always want to make sure that you're ready but you don't want to enter until you see confirmation that the bulls have taken control back, or that buyers are stepping in and supporting price. All right, so as far as the NASDAQ, like I said, I think we've already kind of identified the key levels, even if we haven't. Our ceiling, much like the S&P 500, is a little bit of a band, but I would consider the upper edge right around 373. I don't expect us to break past that. We probably don't even get to that because we've got the 20 and the 50-day starting to curl down below price. We've got a pretty clear descending trend line, and we've got another level that we've just broken down from around 370, 368, which is likely going to lead to the next, if we do bounce, it's likely going to lead to a failure right around this level, and then another head down, and maybe we come down and test 352 around here, or we come down and test all the way to 342. So more likely than not, we're going to see more selling from here to next Wednesday on the NASDAQ as well. If you are looking, if you're still bullish and you want to, you're still expecting a bounce, you really can't get excited about it until we break through this area and we're back over here. And I think if we're back over here, then this ends up being a false breakdown, and probably the environment is much more conducive to long trades once we're back up here. Risk reward will be poor, so we'll still have to be kind of careful about how we trade. But I think any bounce from here until we get above that, I think any bounce is suspect and more likely than not going to lead to a further drop. All right, we look at the Dow Jones, and while it's more of the same, we do have a little bit of relative strength here. And what I mean by that is you can see with the Dow Jones, we did break this descending trend line. We did make our way back up to the moving averages. We did still fail, just like the other two indices did. So we still had this breakdown, a bounce, and a failed breakdown. But the Dow Jones is still threatening to hold above this descending trend line. Now we want to be a little bit more careful about this. We could put the trend line and maybe flatten it out a little bit. In either case, it's still threatening to break above it. And so what we could be seeing here is a little bit of rotation into some of the names in the Dow Jones, or maybe into some small caps, which we'll see in a second, and out of tech and out of the S&P 500. I think if we see this, particularly if the Dow Jones can get back above 345, I don't think it's necessarily a strong case for the bullish, for a bullish move, but I do think it's a strong argument for the case that we are probably going to correct sideways more than just continue heading south. And the reason for that would be that money would be rotating into other areas of the market instead of just a mass evacuation. So this would be a pretty strong sign. And I suspect that the Dow Jones is going to head down just like the other indices and test its current base floor. But if it can get above this, I think that is a very strong and positive argument that the markets are going to continue to correct sideways and not necessarily head further south than some of the areas that I outlined a minute ago. So let's watch for that. Now, if it does fail here and it heads back south, well, 336 is a pretty key support area. I suspect that that holds for now, and below that we would have to kind of really backtrack. As you can see, we've had a major kind of base forming. The Dow Jones has had one of the stranger charts this year as far as being in a channel while at the same time being outside of a channel. And I think at this point it's clearly broken that channel, however you want to define it. I feel like it already kind of broke through that. This channel here kind of ended as we accelerated above it and then as we started trading sideways. But there was a persistent trend line that kind of showed that there was a certain momentum that continued, and if that finally broke pretty clearly. But we're still in this broad consolidation range that we've been stuck in since about April. And that floor is around 336, and so until that floor breaks, we can assume that the Dow Jones is going to be trading back and forth. Now, we have to be careful because if it does break that, it's probably going to lose the 200-day moving average. And that would probably not be a good sign for the overall markets. Anytime the Dow Jones is below its 200, there tends to be a lot more negative reports on the news, and people start to get a little bit more antsy and more negative and more scared, and that could lead to other other volatility or other poor price action across the other indices. So we need to watch and see what happens here. I think that the Dow Jones at this point becomes one of the key tells for us as far as how the market is going to move forward. If, like I said, if it loses its 200-day, I think that bodes poorly for the markets and probably means we're going to see correction across the board. If it holds up here and actually starts to make its way back into the moving averages, while I don't think that means that the markets are going to rally, I do think it means that the markets are going to chop around rather than continue to correct strongly. And so those are basically the key levels here. We have a very key level of 345 we want to get above. We have a key support at 336. And we have a ceiling around 351 that I don't expect us to break through. Even if we do get back above here and start to challenge the moving averages, I don't expect the Dow to get above 351, at least not from here to next week or probably even the week after that. And then finally, the last index we want to look at is the Russell 2000, and looking at the ETF IWM. And this is very similar to the Dow Jones in that it has been stuck in a sideways range for a while now. It lost its upwards channel like the NASDAQ way back in March or April, and it's really just been trading sideways. And the one key takeaway we can have from this is that just like the other indices, it kind of corrected recently, but it's holding up much better in the very short term. You can see it bounced up. It's dealing with its moving averages right now, but it's kind of holding above them now. That said, it has been relatively weak for so long that it is currently challenging its 200-day moving average, despite the fact that it is showing some relative strength compared to the other indices. It is still down over the last 2 days, just like everything else. It's actually down the most today. But with respect to where it stands now, it has held up okay, and it has broken through its recent descending trend line and is able to kind of challenge its moving averages right now. This is another one like the Dow Jones where I think the key takeaway here is how it behaves with respect to the other two. And if we see strength coming back into IWM, I don't think it means the markets are going to rally, but I think it does mean that the markets are going to kind of consolidate more and trade sideways more. If IWM loses its 200-day moving average, I don't think it's the end of the world. I think it would be more impactful if the Dow does, because IWM again has been weak for so long that its weakness doesn't necessarily impact the markets as much as it should. If it does fall too far below that, though, I do think it starts to maybe have a negative drag effect on the other indices. The key is that we don't lose our base, which is down here around 207. That's the area that we want to make sure we stay above. And there's plenty of room here, so there's a lot of room for wiggle here before we really have to worry about it. But ideally, what we'd like to see here is a bounce and a move back above the 50 and the 20 and for it to challenge 225 or so. Maybe try to get back up above 298. The key levels here are a little bit trickier because there isn't anything very clear that isn't down here at 207 or up here at 233. I think there's potential for IWM to wiggle back and forth between those areas. And so at this point, I think it's a lot harder to define where IWM is going to go compared to what the other indices have. I think the other indices have clear areas that need to be tested, whereas IWM is really just stuck in the middle of a pretty broad range. And I think if you really want, you could consider the short term to be the 200 and this 225. And it's probably going to go back and forth between them, but I think it could wiggle in and out of either one of those. Alright, so that covers the four major market indices. I think as a summary, I would say that I'm expecting weaker price action from here to next week. We might get a bounce, but I don't think it's going to be a strong bounce, and I don't think it's going to be a sustained bounce. Which means I'm not really looking to trade this week. I'm pretty hands-off as far as the stock market is concerned right now. I am looking to see where the next buying opportunities are and where we could find some basis to go ahead and build out and trade long from. But at the moment, things aren't palatable right now, and I don't think that we have very good risk-reward or very good trading opportunities. Let's take a quick look at the US dollar. You can see a big breakout here. When the US dollar breaks out like this usually puts pressure on everything, on equities, on commodities. because they're priced in U.S. dollars, right? And I think that this again is indicative of a strengthening U.S. dollar is usually indicative of the anticipation of, at the very least, if not rate hikes, at the very least a little bit of a slowing down in some of the printing that we've done recently. And so that has been, we're reacting poorly because of this, and that's part of the pressure we're seeing across the board, even in cryptocurrencies and even in gold and silver. And we'll see how long this lasts, and we'll see what kind of an impact it has. But for now, we're definitely seeing a strong move on the U.S. dollar. If we look at the euro U.S. dollar, we're going to see the opposite, right? We're going to see the euro starting to really cascade to the downside as the U.S. dollar picks up some steam. And so this is what we've been looking at and what we've been anticipating to happen for the U.S. dollar to really pick up strength and start to push and really push the envelope here. And it's doing so. Now, we're going to have to go to a weekly chart to see what the next stage is. And as you can see, we're kind of at a level here that could hold a support. But if not, there is room for the U.S. dollar to rally pretty significantly before it really finds the next level for the euro, what the euro would consider to be support, right? We're kind of at a level here between the 200-day moving average and this 116. But if the U.S. dollar could continue to push through that, it could head a little bit further south. Now, that being said, I think at this point the euro probably is going to bounce. It's going to be a weak bounce, but it'll be a bounce to kind of stabilize, and then we'll see what happens next. We look at the U.S. versus the yen. Again, U.S. dollar, strong rally, really ripping across the board. Broke through this channel it spent a lot of time in, and is up to new highs. Now, the only thing here is, again, it's up 6 very strong days in a row, so it's probably going to stall out soon. Maybe print the bull flag, and then probably try to continue rallying. And then we look at the U.S. versus the Canadian. That one has had a little bit more of a muted move, but it's also bouncing as well. And it also bounced at what was a pretty easily identifiable support zone. A little bit more volatility here, a little bit back and forth. A lot of that due to what we're seeing in oil right now. You can see oil rallying as well. Now, this is pretty good because oil is rallying in the face of a U.S. dollar rally. It is stalling out over the last couple of days. It has hit resistance, and I suspect at this point oil will probably pull back and head back into the mid 70s and lower 70s. If you have traded oil or oil names recently, this is a good place to take profits. There is always the possibility oil can break through here, but with the U.S. dollar as strong as it is currently, and with what we've seen out of oil recently, I think that this is a good spot. Maybe if you are, you don't want to close out the entire trade, you don't have to, but at least taking 50% profits. Because I think there's a pretty good chance it comes down and tests at the very least 72, and it's 20 and 50-day moving averages. And there is still the possibility that this is going to be a new range that develops, and this could be a ceiling that is going to be difficult for it to break through. So I personally, if I was in this, I would be looking to take some profits here, and then maybe you could hold a portion just in case it continues to break out. But I suspect that it's going to stall out at these levels. And then finally, the last commodities to look at are gold and silver. As you can see, gold struggling as to be expected with the U.S. dollar bounce, and silver struggling as to be expected. Anyone that follows me regularly knows that I have not had any interest in gold or silver for a while. I have found them to be incredibly poor trading instruments over the last year or two, and have not really wanted to trade them. I still look at them because they're major commodities that a lot of people follow, but I don't like the price action I'm seeing on them. It's very sloppy. It doesn't really respect the technicals very well, because it's a 24-hour market cycle on an instrument that only trades during the normal trading hours. And so you get a lot of gaps. You get a lot of movement that happens overnight that you don't see reflected on the chart till the next day. And on top of that, they just haven't really shown the strength or exhibited the strength that we wanted to see when the U.S. dollar was weak. And now that the U.S. dollar is strong, they're starting to get punished again. So, not much I want to do. I don't really want to spend too much time on these because I don't think that they're good instruments to trade, and I don't think that they're worth trading now, considering the strength in the U.S. dollar. So the last thing we want to look at is Bitcoin and Ethereum. And as you can see, they have also been within the middle of a correction as well. A pretty volatile correction, as often happens with these. You can see Bitcoin topped out around 52. It basically dropped all the way into the 40s in one day, and then now it's all the way down to 40. And you can see exactly what's happening. Now, the one good thing for cryptocurrencies is they do tend to kind of follow the technicals. And so we've got a pretty clear pattern here, and we know exactly what we want to see out of Bitcoin before we could get excited about it again. Now, those of you that follow me regularly will know that when we were at this stage, I had mentioned that you probably want to take profits on the next bounce because there was more correction to happen. And that's exactly what we saw. We had a little bounce, and then we had a further correction. I think at this point, we're getting close to what could be a definable bottom. Now, with that being said, I also think there's a pretty good chance that there's going to be a shakeout that drops below this before we really start to rally. So I'm a little bit nervous about saying that this is a good spot to buy because I don't think it's a good spot yet. But I think that it will eventually be the spot that we consider to be the bottom. So what I mean by that is we can maybe come up, fail, and then head down and maybe dip into the 30s before we break out. But I think eventually what we are going to see is Bitcoin set up a nice bounce move around here. And at that point, it's going to be a good long play. But I don't think we're there yet. I think we need to be patient as we wait because Bitcoin has very strong volatility and can drastically move back and forth. And so we don't want to be early on something like this. But you can see this is exactly what happened last time where we had this play out where you had this bounce back and forth, and then eventually you had the breakdown that looked like it was going to be a strong breakdown that was eventually met with the buying pressure to go ahead and push to new levels. And it could be that we're going to see something very similar. I don't know that we've seen enough volume or enough volatility for complete capitulation here. So I think that there's still room for downside, but I do think that this is a level that will ultimately hold as probably a good level to go ahead and buy. We look at Ethereum, it's printing a very similar pattern, with the one difference being that it is falling a little bit below what was the previous resistance level, right? You can see that this was the ceiling of that range that we spent a good portion of the middle of the year in, and we broke out above it, and now we're kind of really threatening to break down. But other than that, it's basically very similar. Again, if you take a look at Bitcoin, we had that same base that we formed earlier this year, and then we've just kind of had the two strong moves to the downside. We've got that descending trend line, and it's the same basic premise with Ethereum. We've got the two strong thrusts to the downside, we've got that descending trend line, and we've got this base that we're kind of hovering around. And very much like Bitcoin, we just want to see what happens here as we build up some momentum to break out. But I think that this is still probably a few weeks away from what we could consider to be a strong high probability trading setup. It could be Bitcoin and Ethereum rally today and just break out and push through all these levels. Could be that they break down and head lower. But what we don't have right now is a high probability setup, and so we need to wait and be patient and wait for what gives us a good trading opportunity. I think that's something a lot of times traders mix up, is they think because the stock went up that it was a good trade. And it's not always a good trade, even if it would have worked out for you, because it didn't give you the right probability of success, or it didn't give you the right risk reward for a good trade. So right now what we want to do is I'm just waiting for a better trading opportunity. I think that we're still in for some more chop. I don't think we're really out of the woods yet as far as this short-term correction that has come in has taken place. All right, so those are my thoughts on the equities that I like to follow as far as the broader term or broader perspective is concerned. If anyone has a chart they want me to look at, feel free to type it in now. If not, we can kind of wrap it up for today. If anyone is watching this as a recording and you ever have a chart you want me to look at, feel free to message me on Twitter @StockDarts. I'd be more than happy to go ahead and take a look at it and just send you the chart through that. Um, I try to help out traders as much as I can. I do these things for free. I don't get anything out of this. I just want to make sure that traders understand technical analysis and use it to their benefit. When I started trading a long time ago already, but there were a lot of people that considered technical analysis to be kind of snake oil, and anyone that used it was basically just connecting dots and was a kind of a charlatan. And what I found in more than almost 2 decades now of trading is that technical analysis does a good job of giving you a gauge on market sentiment and on market psychology. And I think what you need to understand when you look at a chart is that you're not really just looking at it. So, for instance, this isn't just a chart of Ethereum. This is really a picture of what people think Ethereum's price is. And so these trend lines, they're telling you what market sentiment is, whether it's getting stronger or weaker, or what people consider to be base value is what the horizontal lines give us. And so when you use these lines, they're giving you a good picture of what traders think. It's not just that you're connecting dots on a chart. You're basically visualizing overarching sentiment and overarching attitudes about a particular equity. And so I try to share that and try to get other people to enjoy it and maybe hopefully benefit from it. And so, like I said, if you ever, anyone in here or anyone watching this as a recording ever has a question, feel free to reach out to me on Twitter. I'll be more than happy to go ahead and help out. Other than that, it looks like we don't have anything else to cover for today, so we can go ahead and wrap it up, and we'll meet again next Wednesday.